What has changed in your life from before the election result to now knowing? The energy and bandwidth that's going into things that are out of your control versus what you can control. It surprises me about how much bandwidth is going there. Grab life by the horns. And if you have friends that are complaining, it's like, hey man, how much is the government spending federally on this stuff? And you're worried about your one home. Stamp duty is a state thing. If you want to kind of dictate and live life on your own terms, you can't be relying on the government to help you get there.
The government will make moves that in a decade will come into fruition. It's a slow moving ship. If you wait 10 years, the market's going to move without you.
G'day everyone, welcome back to another episode of the Australian Property Investment Podcast. I want to start off by saying a massive thank you to everyone that's tuning in. The feedback that we're getting from people, not only on YouTube, but through our website and our socials. First of all, a heartfelt thank you so much for giving us your time and energy. What's the saying? With great power comes great responsibility. So for everyone that's kind of giving me your time, I want to repay that by giving you as much knowledge, insight that we have behind the doors here at Atelier Wealth, and make sure that you walk out of this, or step out of this episode with just a little bit more knowledge under your belt. I want to start off by saying, by the time this episode goes to air, guys, the election will be done and dusted.
Oh, yeah.
And as you're listening, I just want you to stop and think, what has changed in your life from before the election result to now knowing? Because I'm looking at it going, not much in my life is going to change. And I think this has really been a penny drop moment for me. The more people I speak to that are really spending a lot of time, and granted, this is our country, and I want to say it's a massive responsibility, and what a right it is to be able to vote in a democratic country. Though it's not rigged, there's so much to love about Australia. What a wonderful country that we live in. I want to start by truly saying how blessed we are to call Australia home. But on the flip side is the energy and bandwidth that's going into things that are out of your control versus what you can control. It surprises me about how much bandwidth is going there. And I just think energy management becomes a massive thing is what I speak about here. So I just want to stop and reflect. What's truly changed in your life and what can you actually control? And I leave that as maybe a thought provoker as we come into this episode. And the reason why, because I had dinner with a really good mate and we're talking about some of the stuff that's happening in the election. I was like, look, I just picked up one of the debates and I want to start with a question. How much do you think federal government spends on the defense budget in 2023, 2024?
Question for us?
Yes.
Yes, a question for us.
Hundreds of billions.
And sorry, when I say us, if you're listening on there, I've got Damien Walker, I've got Nate Condy from my team in here as well. So intros to the boys, if you guys know them as my right hand, left hand in the team. Go back to the question.
Cool.
What are we spending nationally on defense?
Yeah, so what the sub deal was worth 40 billion, I think. So
Over a few years, probably.
over a few years. And then we've got everything else to go. I'm going to say 50. I'm going to say 50 billion dollars a year.
Nate?
200 billion.
Oh, all right. Damien's close. 53.3 billion. All right. What about NDIS?
Okay, so NDIS, that's got to be billions. I'm going to say 8 billion.
Nate?
8.1 billion.
You guys are way off. 46 billion.
Oh,
And that will get to 93 billion in 2033 at 34 in 10 years time. That will double. So I just want to start there as a bit of a preface. I'm talking about billion with a B, and let me explain to you why I want to go here. When I hear about people and they think about their one property in one suburb, trying to buy their first home, and they put it on the federal government, I actually just can't understand what outcome you're looking for here. When the federal government, and we had like a trade tariff war internationally, for example, we've got defense, the protection of this country, for example, we're trying to run the country, India. Why is the federal government lumped? We're trying to get housing for Australians. Like, it's a very controversial thought, but I just want us to zoom out a little bit and go, hey mate, put matters into your own hands, grab life by the horns. And if you have friends that are complaining, it's like, hey man, how much is the government spending federally on this stuff? And you're worried about your one home. Stamp duty is a state thing.
mm-hmm.
Sure, there's incentives, there's policies that happen at a federal level that will now enable first-time buyers to get into the market, or enable single parents to get in the market, older Australians. I absolutely love these policies. Ranger super, whatever they can do, they will do. But if they're trying to solve the housing crisis, absolutely not.
Oh, definitely. I mean,
Absolutely not.
even planning, zoning is state and council government,
Or state government.
right?
Absolutely, mate. Let's also go here for a second. And I guess where I'm trying to get to is what's the role of the government and what's the role of the individual?
Mm.
And I really feel like if you want to kind of dictate and live life on your own terms, you can't be relying on the government to help you get there.
The government will make moves that in a decade will come into fruition. It's a slow moving ship. You're moving a country, right?
Yeah.
So policy will come into place, like Albo's $100,000 homes.
Yep.
And then what is it for first home buyers, or there's a portion for first home buyers?
I mean, it's part social for housing as well.
They're not going to build that once they get elected next month.
Yeah.
Albo used to build 100,000 homes. I don't know. They'd have a projection, but they're obviously going to be out as well by however many years, because every government project is delayed.
Yeah.
So it's like, yeah, all right, the government's going to help, but it's going to take a long time.
Mm.
If you wait 10 years, the market's going to move without you.
I mean, homes should double. Homes probably should double every 10 years. Is the general? Is it?
Yeah.
Let me just also on this vein. Let me talk about empathy, and I'll frame this by saying I can't expect our politicians to have empathy for the working class. Let me give you an example. Could you empathize with a single mum, Damien?
No.
No. Nate, can you empathize with a family of 3 kids? You don't have kids. If I was to try and empathize with someone at $65,000, with all due respect, I don't earn that anymore. I can't understand your problems, my friend.
Mm-hmm.
Like I'm and if all my friends or all my social circle were all privileged and we didn't know the price of petrol, we never had to worry about paying for the kids' education, we never had to worry about the flights, we didn't have any economic problems to worry about because we were in a federally elected seat and a lot of this stuff is taken care of. They wouldn't know the price of going to the Bowser and filling up they would not. It's all on the company card. It's all on a government fuel card, right?
Oh, that's the main headline today. Dutton said the carton and eggs was worth $4.
Yeah, you would. It's not, and to me, it's not that they're out of touch.
Yeah.
It's just like that's not their concern.
Yep.
Like I wouldn't know the price of some things in our office even. That doesn't make me out of touch. He goes, that's just not in my remit. And I'm just you're trying to get someone to solve the problem. They've got no empathy in. Like, how on earth are they going to try and solve a problem for working Australians on a single income with soaring inflation and household bills and everything, when they actually cannot empathize with that problem?
They do try.
They try, but they do a terrible job because they can't take themselves back to that place.
Well, going back to my other point, the government can only do things and then they move the needle so slowly and by just a little bit.
Yeah.
Just enough so we don't riot the streets.
Mate, correct. And I feel like that's just what I wanted to really double down on the start of this episode going, if the energy and frequency that you have with people around you that are playing that space and you're trying to play a bigger game, and let's put this on the table, while there's so many Australians that are struggling to buy their first one property, we've done strategies this week that have probably shown people how to buy 5 properties this year alone. That's nuts. But when you think about, if you're listening, let that sink in for a second. People struggling to buy one property, and you come to us, and on our watch, we're getting to buy 5, 6 properties in a year, become a 1% property investor. You are at this stage, you're automatically uncommon.
Mm-hmm.
You're automatically a 1% property investor that renders you uncommon to everyone else.
Mm-hmm.
And I think that's where you can't then empathize with the person trying to get their first property when you've automatically gone and bought 4, 5, 6 in 1 year. And I think that's a real headspace to me where I try to get people to really move the needle and shift gears going, it's not a position of privilege and you don't care about anyone else, but your win has not come at the loss of that first home buyer. They're not buying in Perth or wherever suburb you're buying in if they're living in Sydney. You haven't stolen their dream of buying that first home. So don't feel guilty about it is what I'm trying to say. Don't think your success is derailing someone else's ability to get into the market. In fact, if you're buying and providing rent for someone, you're doing the government's job effectively at that point.
They love it. Yeah, both Daniel said, yeah. That's what they want. And so it's all like you're looking stop looking towards the government, start looking towards your broker.
Yeah.
See, like you can look towards the government. They can't actually do anything for you individually. They can move the needle for a broad population. But if you want a plan for yourself, then you've got to speak to either a broker, a planner, your accountant, and start to do something in place, a strategy in place to get it done.
Do something. Cool. So what we want to do is start here and take you on a journey to go. So what are the common policies that we're seeing? What are the problems that we're solving? What are the situations that we're unlocking that are getting results? So we want to let you into our world to show you what we're doing on a day-to-day basis that hopefully will solve maybe one of your pain points or someone in your circle that's suffering in silence with some of these issues, and go, bang, let's move this issue out the way, barrier unlocked, and let's move to the next level in your growth as well. So Nate, you boys have heard me talk, and if you're listening, I'm very big in what we call strategic mortgage broking. So these aren't loans that we're just kind of peddling. We're not peddling product here. It's actually solving real problems here. That's what I call strategic mortgage broking. And if your mortgage broker isn't speaking to you in a strategic way and coming with what we call a plan on a page, i.e. a loan strategy, I'm not saying just only choose us, but I'm saying question if you've got the right broker in your corner as well. So let's fire through a couple of policies. And let's start with probably the most simple one is what I think, which is I can't get a loan because I'm on probation.
Yeah, that or I'm brand new in my job. Like, I haven't even started yet. I'm starting a job in a week's time.
Yep.
Mm-hmm. We can get you going with an employment contract, first pay slip. Once, you can get pre-approved without a pay slip, right? As long as you've got the employment contract, to having a pay slip by the time, formal approval is due. Yeah.
Yeah. If you're listening and you hear someone say that, I just got to shut this down. You can absolutely get a loan on day one on the job when you have an employment contract. Not casual, but if you're permanent, part-time, full-time, for example, we can definitely use that income. And I don't know how long this old wives' tale's been bandied around for, but I've just got to say, at no point now if you hear it on your watch, you say, absolutely, mate, you can get a loan if you're on probation. So don't feel like you got to serve out 6 months to then get a loan or rack on.
History of employment. I remember I did a loan for a 60-year-old who was just re-entering the workforce after 10 years off.
Yeah.
One pay slip and we had the loan done.
Yeah. And we're not talking like non-bank lenders here. We're talking two of Australia's biggest banks.
Yeah.
Two of Australia's biggest banks. This is their policy. And it's been that policy. I've been broking for nearly 10 years. It's been that policy for 10 years. So this is not something new that's happened. This has been around for a long time. So I want to say tick on probation.
Awesome. Another one, maternity leave. If you're on maternity leave, again, the major banks, most of them will take you pending a return to work letter. But I just need to see your return to work salary, how many days you're working, and the date. Good to go.
So the question sorry, Damien, I need to jump in. So the question usually comes up is, I don't know if I'm going to return to work full-time, part-time. That's not a deal breaker at this stage. You go, look, get the return to work date. Maybe if you're thinking to go back 3 or 4 days, or if you're going to return back to work 5 days, and then it's like, I've got to have this awkward conversation with my employer about my return to work. Explain and say, look, this is what I'm looking to do. We're going to the bank to get a loan. I'd like to get a return to it that shows this is my full-time income and I can return to the role in a full-time capacity should I want to. You're not beholden to this letter in the sense that, hey, look, if things change and you decide now that you want to go to 3 days instead of being full-time, you're allowed to change that once you're in the role, but just know you're managing cash flow in terms of your repayments as well. Okay.
Correct. And just the other thing is you've got to have a savings balance to cover the repayments while you're on mat leave or returning to work, the shortfall of the servicing.
So what Damien's alluding to there is, if you get the loan and you got, say, 3 months or 4 months before you go back into your role, a bank would like to see that you've got some savings to cover those repayments that will bridge that 3 or 4 month gap before you're back in your gig, which for a lot of our clients, we do see that as pretty common as well. And I think when we go back upstream on this policy, it's like, hey, why are we trying to get a loan while we're on mat leave? It's generally because now we're going to a nesting period, or we know we want to put down roots, for example. And I say a child will generally take off $50,000 to $60,000 off your borrowing capacity. So if you are in the midst of family planning, I always say, get the loan before the baby comes along and you'll find a way to make ends meet. I'm telling you this now, first-hand experience. I can tell you now, 2 kids under my belt, you will find a way to eat and pay your mortgages as well. So if you're sitting there in the spreadsheets and going, man, we're not sure about cash flow, trust me, you will find a way, because as time goes on and then you have reduced return to work income and you have a dependent, the only thing that's going down is borrowing capacity. The only thing that's going up is property prices on where you want to live. Yeah, fact. And I'm like, look, I've been tested on this numerous times, and people come back a year later and like, with them doing their numbers and their borrowing capacity was better a year ago, even when rates were higher compared to what it is now. It's a little tragedy on my watch. I just don't want that to happen.
Cool. Another one of your self-employed applicants maybe thinking it's too hard to get into the market. Range of policies nowadays, just using your wages, not even needing to provide financials. Recently, one of the big banks has brought out a policy, no ABN requirement. They'll accept as long as you got one tax return, which is a game changer because everyone else needs at least 18 months ABN, 1 to 2 tax returns.
So let's go there. So if I'm listening, and I know a question is even when our lender partner came out as well. So we say no minimum requirements. So you could have the ABN registered, last week?
Yep.
But you need to
come on, it might be a bit low if you get in the tax.
There we go. So this is it. So the ABN can be recently registered, but the income verification. So someone's listening, they're self-employed. How do we verify that income for that particular bank?
Company tax return, or if that's for company applicants, if you're a sole trader, individual tax return.
Cool. HEO portal.
So that's for director's salary.
Director's salary. Cool.
Yeah. With it's a niche. So 6 months. It's only for like people who like maybe an IT contractor, a real estate agent who's gone from PAYG to straight comms through an ABN. You might have had a bumper 6 months, Jan to June.
Cool.
And that's where you've got 6 months of ABN, 6 months of income. You've done your tax return. We can use it. And to wait for a full year with only a handful of lenders even then.
Helpful. I think the scenarios, those examples are super helpful. Thanks, Damien.
Yeah. Another self-employed policies, if you got company debts and I guess your broker's told you that they're weighing you down, there are some lenders that will exclude company debts as well.
So let's talk through some of these company debts that we typically see: car loans, machinery,
company credit cards.
Yeah.
So again, to give this some context, let's put this as Atelier Wealth. So Aaron, I own the business, for example, and I have 2 company cars that are costing me $5,000 or $6,000 a month in repayments.
Mm-hmm.
And in turn, that's now reducing my borrowing capacity. Well, what I can do is I can show the fact that I'm paid a salary from the business on a fairly consistent basis. And I can use that almost like I'm PAYG with regular salary. And we can exclude the fact that my business now has these debts in there. And I mean, quite often we see a lot of businesses trading with, some debts. So whether that's through machinery, they're investing back into the business, taking a loan, whatever it's going to be, there's some debt in the business. And a lot of the businesses that are on that growth trajectory do typically take on some level of debt. So what we're saying is we can actually factor that out and just work purely on your incomes. Now, the catch-22 here there is if you're not paying yourself as a salary, that's probably where the Achilles heel is.
Correct. But there are some lenders who will still use your company profit and exclude the debts.
Cool.
So there's only maybe 2 or 3 that come to mind. A lot of the non-banks will.
Yep.
Majors, or traditional lenders 2 or 3. But that's beneficial if you like you said, you're not paying yourself a salary, or you're paying yourself quite lumpy, as most business owners will. You got your profit sitting in your business. Yep, 1 or 2 lenders.
Yeah. I think what we really want to get to with this self-employed discussion is play on, man. Like, give us a scenario, show us what's going on here, and let's find a way. Because what you can just hear here, we've just quoted, these 2 banks will do it, these 3 banks will do it. There's got to be a way. And I feel like self-employed, particularly self-employed property investors, raw end of the deal, where I'm like, look, you've heard me probably say in another episode, sweat equity and property equity. You're working extremely hard in your business and you're not seeing the dollars, whereas people that have gone and bought property are doing better than other people that are self-employed with blood, sweat, and tears. That's a tragedy. In my mind, that's a tragedy that like self-employed people aren't paying themselves super. They're not paying themselves what they're worth in market.
Mm-hmm.
Sometimes their team are earning more than them and they're not building an asset base. And then people that are salaried, that are earning less than them, working less than them, are now building an asset base that is compounding and they're not keeping up. Like, come on. If you're self-employed and you want to grow your portfolio and your business, I think you can have your cake and eat it too.
Yeah. And there's other ways we do mention, like low doc loans using counter badges if you don't have tax return.
Well, if you're trying to minimize, if your goal is then minimizing our income tax, and it's like, well, I don't want to pay the tax. All right, cool. So you don't want to declare the big income. You still want to pay minimal tax.
Paid a higher rate.
Cop a higher rate. Yeah, correct. And it's not like you're getting murdered on it, but it's got to be less than paying the income tax on 100K potentially.
I think low doc rates are getting very competitive. Ever
Super.
since we had the incredibly low rates, they used to be so unattractive. Now they're like 0.5, 1% higher if you've got no credit impairment.
Correct.
Play on.
There's one bank in particular, non-bank lender, who has the same rate for full doc or old doc at the moment. So it's like
There's no difference.
I need you to get it.
Yeah. It's fantastic.
And I feel like I don't know, sometimes when you have brokers that, I mean, I've speak to a lot of brokers, and there's some decent brokerages. They do not do any self-employed lending in this space. I was like, holy crap, like you're a broker and you don't do any self-employed loans. Like, no, absolutely not. So you got to understand, like, again, I'm not tooting our own horn here, but I've got to talk about like the industry as a whole. Not every broker is created equally. You could literally put this same deal in front of 5 brokers. You could probably get 5 different results and different perspectives. Who can then look at, okay, have we made additional contributions to salary? Bang, add that back, for example. Are there donations or something? Bang, add that back. And so the ability to add back, then it's the ability to go to those lenders, 1 year financial. So you might have had a cracking 2024, but your 2023 was down, for example. Use the most recent financial year. So understanding, as someone that's self-employed, we're self-employed. Like, I think we're broken ground. Like, I've probably gone through most policies and gone, show me where this, show me where's this, show me where's this. And we'll probably attract a lot of self-employed clients off the back of our energy going, give me a problem, we'll solve it. And that's my message to you if you are self-employed.
Cool. Couple more simple ones we've got noted here. Commission policy. Generally, the average is around 6 months. You need to have evidence of. You can get in with 3 months of commission. The bank will annualize that, or one bank in particular. Whereas some will want to see 12 months. But if you got commission, you've got 3 months history or 6 months history, good to go. Good to annualize.
Yeah. So that's a lot of our sales, tech sales clients, medical sales clients earning strong commissions, and they might have changed, or, they've come into a really strong quarter. And it's going, well, you could work off that last quarter, the last 3 months of commissions. And then what we do is when we annualize it, you're timesing it by 4. So we're timesing it by 4 to work out how much you can then borrow off the back of that. Don't let that be a showstopper. In fact, just ask the question.
Yeah.
Just ask the question. If it's not, this is what it needs to be, at least and there's a bit of direction. Okay, I can bank up some commissions for my next quarter. So then we work off 6 months, and it just opens up more lender scope at that point as well.
And then bonus income, banks typically they want to see 2 years of history. Now, a lot of shifting to just 1 year. So if you got one bonus payslip, you could also, get in. And anymore.
Yeah, this is again where banks want to see like 2 years. I mean, when I started, they want to see 2 years worth of bonus history.
And then you'd be like, oh, but we've changed roles, got bonus on the previous employer, not guaranteed for that second year.
Correct.
They used to be so strict on bonus.
Yep.
And then 1 or 2 banks opened the door, and God, what is it now? They have 5 lenders, 6 lenders, you reckon? Yeah, they do 1 year bonus. So fantastic. And if you're jumping around jobs, like Aaron mentioned, like people work in sales, you jump around looking for a better employer, right?
Absolutely. Always want to stepping up for a better opportunity.
Yeah, where's my second stepping up your rent package? Yeah, better base, better comm split, selling something different. So if you're doing that and you're jumping around every 12 months, some banks will just go, no, can't do it. Don't see the consistency. But there are some lenders who go, great, let's do it. 3 months for comms, 1 year for bonus, play on.
Yeah. And again, let's go back to sentiment and rhetoric. When people go, this is a really hard time to buy, we're looking at this going, this is a really good time to be getting a loan, to borrow. This is a really good time to be borrowing. Like, rates are coming down. People's incomes are pretty strong and consistent. I think that volatility come out of COVID, but definitely cleared the air on that as well. That any property you probably buy at 90, 100% finance is going to be negatively geared. So then we've got to factor in cash flow, and I'll come to I think what I call the triangle of investing. I'll come back to that in a second. But I'm just trying to say, with the amount of changes that we've had in lending policy, we are genuinely excited when we very rarely will find a deal that like, or a scenario where we can't do it. In fact, I don't think there's really any scenarios that come across our desk where we have no option.
There's so many options. It is like a cycle, right? Like policies tighten, they loosen. Royal Commission 2019.
Yeah, it's going back a few years.
Everything just went pulled in.
Maybe go back to 2014, 15, interest only slowdowns, so 30% caps on the amount of interest only loans a bank will do, mate, far before your time, Nate. And we're sitting here going, can they, will the bank
spend a deal too? I remember we spent this sure thing deal, and then the bank just said declined. And we're like, why? They couldn't tell you it was because of the caps.
That's it.
They had too many deals in, but they were just like, we won't do the deal. And the poor person's like, what's wrong with me? I'm like, well, it's like,
no, they've literally hit their 30% cap on the interest only exposure.
So every month, Nate, if they put, 30% of your loans to be was it investment
interest only? Correct.
And once you hit that cap, you couldn't do any more. So people are getting declined, and you weren't told where they were at with their cap. And now it's like we're back into where policies are starting to open up again.
I mean, CBA, I'll let you know a lender, when the nation's biggest lender, CBA, will do a 95% investment loan. I mean, when I saw that, I was like, mate, they're back.
Yeah.
They're back. They're ready to rock and roll. Yep.
Cool. So that's everything I got for, I guess, this simple, we do rattle on all day.
I got a
couple of new policies that have come out in the last few weeks. One non-bank lender is now doing no LOI up to 90% LVR. That's for individuals, trusts, investment, owner-occupied, P&I, interest only. There's no real cap on it. Don't have to be employed in any particular industry. I'll just waive it.
Yep. And when does that end? It's a special. It's app submitted by, I think,
Mid-June.
Yeah.
Yeah. So that's a good one.
I'm hoping they extend that. Like if the campaign's gone to plan, they may extend it.
Mm-hmm.
Yeah, they've been doing rate promos for the last year probably, and they're always extending them, tweaking them slightly. But yeah, we'll see. And then another bank, major bank, has also changed the way they're looking at HECS debt with all the talk of, I guess, the government around.
I mean, it's common knowledge. It's common bank. It's in the media.
Well, yeah. What they'll do, if they assess you paying off your HECS in a year, they'll completely exclude it from your calculation. So they'll say if your income's 100K, your HECS debt is 5K, for example, you'll pay that off in the year. So they'll waive that. If it's anything over a year but under 5 years, they will reduce your buffer to 1%, down from 3%, which is awesome.
Does that have a bigger impact on borrowing than cancelling the HECS? Have you done any scenarios?
I guess it would depend on the income.
Oh, it depends on the income because it's a tiered percentage based on the income for the HECS repayment.
Yeah.
But surely, like for an 80K income, to reduce the assessment rate by 2% would be a bigger boost than getting rid of the HECS.
Yeah. Yeah, it could be. So,
you know, it'd be a cool experiment to do. Find out, now it might be tough because we've got a lot of clients, but find out how many of them are 1% property investors and see if if we have more than 1% of our client base.
I would back ourselves that we've got a strong representation of top 1% property.
Totally. We've got 5%. It's a good marketing campaign. 5% of our clients are 1% property investors.
Yeah.
All right. Shot not doing it.
I love how you just throw ideas out there and go, right, you guys figure it out. Yeah, good one. Good one. All right, mission accepted, challenge accepted. Let me find out how many of our clients are sitting in those categories. And I think what we need to do is exclude owner-occ, because there's some people that have exclusive owner-occ property.
Yeah.
This is investor. So I have to overlay that with investor.
Yeah.
All right, cool. Let me come back to what I would call our loan strategy framework. And so if you're listening, it's probably best we'll show this on YouTube, for example. I might even try and get just a one page that will show this. And effectively, when we as loan strategists are looking at your scenario, here's the three parts that I'm effectively like a triangle that I've drawn out. That's the three filters that we're looking at as to what problem we're trying to solve. So come with me here. Step one is, are we trying to unlock an equity problem? So for us, are we trying to pull the equity to go again? So let me give probably Nate's a good example here. You've bought your two properties and now you want to go for the third. And so maybe we've got to try and strip the equity from those two to go again, particularly if you didn't have like a large cash deposit, for example. Okay. So that would be a very good example. How are we looking? So then what we're doing is tactically running as many valuations as possible. Then can we go, hey, look, we can go to a bank that's going to let us do 90% on a computer-based valuation or 9% on a valuation, for example. So that's what we're doing. Or can we do a guarantor loan, for example? It's going to get you the equity that you need, the deposit that you need. So equities for deposits is one problem that we're trying to unlock. Okay. So then we move to borrowing capacity. So the next part is then, okay, what are we trying to solve a borrowing capacity problem? Because we've got clients, we did one yesterday across the portfolio for about $650,000 worth of equity. Sitting on one second, all these properties have gone up in value and she's on a fairly modest income. So now what we're trying to do is go, modest income is about 120, 130,000. And now what we're trying to do is how do we stretch her borrowing capacity to get her to buy us into that 6th, 7th, 8th investment property as well. So she's got great equity, but it's almost teasing her the fact that she can't pull it out. So now we're doing a bit of the dance and shuffle with finance to go playing the game of finance. How do we get her that borrowing capacity to go and buy the next 3 properties? Yes, we could buy through trust. Then we're doing different lender orders and stacks in terms of, okay, we'll go here, take the equity, go there. And I know, and Daniel's probably done the same. We then have this very nice dance around how much equity you're releasing to then buy that property, come back, release more equity, come back, buy that property. And it's like, we're kind of doing this dance now, which I think we've kind of nailed in our strategies to go, let's release the equity, go and buy the 2 properties, then we'll come back, release more equity. Because if we do a massive equity strip, you either got a large servicing on this equity strip that we can't attribute to an investment loan or property, and you're servicing more debt. So if we're saying something, there could be a method behind the madness when we're presenting a strategy. Probably what we need to do is then double down, explain that a little bit more, particularly in lay terms, because even I have to then, even when you guys ask, what's going on here, and tell me a little bit more about what we've done and why we've done that. So I hope that helps. So we move from solving an equity problem or a deposit problem to solving the borrowing capacity problem. And now what we're moving to solve is the cash flow problem. And when I say we, in all honesty, we actually can't solve this problem for you. This is a you problem. And I mean, we're in together, which means in terms of rates, repayments, do we go interest only? Do we go P&I, fixed, variable? Like that's I'd say that's common stuff. What we want to do is go upstream a little bit more and say, well, hang on, is there expenses you can dial back in, rein back in from a household? I'm sorry, mate, you are going to be negatively geared. Do you look at a PAYG with withholding variation to claw back some income? Do you just not have the cash flow to sustain a property investment portfolio that size? Or do you just need to like hold on, like what I've called in past episodes, grip strength, like be able to hold on and push through, knowing that, rates will come down, rents will go up and your income will go up. And it's just a matter of time of eating some glass to get through to the other side.
Mm-hmm. Yep. Or manufacture some cash flow. Can we get more money for a granny flat, for example, help with that yield problem? There are things, if you're struggling with cash flow, sort of reach out. There's ideas you might not have thought about.
Yeah.
But yeah, I think in today's rate environment, it is a lot of hold on.
Yeah.
And get your budget set.
Correct.
Right.
Be so dialed into your budget. Be so dialed in. Be good with your money. And again, if you haven't read it, read The Psychology of Money. Absolutely get dialed into your budget. You should know your numbers, but don't try and handball. As we've seen this sometimes with clients, they're trying to handball to a financial planner, handball to a buyer's agent, pass the buck to the broker. It's like, guys, you want the properties, you've got to roll some sleeves up and get some work done. We will get you so far. And that's why I say we'll get you this far with the loan strategy. Now you do is engage your buyer's agent to get you the property strategy. That is tactically where you're buying, what you're buying, and why you're buying it. Yeah. So if we go back to that triangle, where you're buying, what you're buying, why you're buying it should form the property strategy. We're coming in with the loan strategy. You match those together and you should have a very clearly articulated plan. Nothing overly complex, nothing up the wazoo on Excel. Clarity on a strategy to help you move forward. Because I'll say this right now, there are some absolute weapon buyers agents that we work with that if they were to put 5 properties on your desk and say, mate, these are gun areas, go and buy these and we'll see some growth, but you can't finance that, what's the point? You actually need the finance to unlock the ability to buy and add more strategic assets to your portfolio, which is why we become so crucial. We being strategic mortgage brokers, not just peddling product, we become so important from a loan strategy perspective. And that takes time. For a new client, it could take us 4 to 5 business days to do a loan strategy, because we get one shot at someone new coming into us, their numbers, and we're trying to do valuations and unlock their income. And they might have been with their last broker for 4 or 5 years. So it's like, well, hang on, we have to have that time and kind of space to think clearly, to put our best foot forward as well. And what's the rush? And that's what I'm trying to tell people is like, get your house in order. Don't be in a rush. Don't be hasty with this. Don't try and find a property before you get your pre-approval. Get yourself, like, enjoy the process, enjoy the experience, because I'm telling you right now, every time it's a stressful experience on our watch, it's because people got on board property before finance is sorted. And that's just a recipe for disaster. We'll do it every single day. Like, we've never lost a deposit, never missed a settlement, right? And you're laughing.
I'm laughing because we've got 3 of them.
It'll never change. We could shout this message from the rooftops. It'll never change. And we're not asking you to like bow down to us and say, look, yep, like in that sense. But it's just more to say, hey, if you want to enjoy this experience of being a top 1% property investor, hey mate, get that pre-approval going. And while you're doing that, get the next pre-approval going. So automatically you can just pick the next one off the shelf and keep going. We don't mind that. We love that. It's like, let's get organized. Let's go to the races and get organized with these pre-approvals. And as soon as one's getting done, we're moving on to the next. The trust might get set up here as well. And it's ability to, again, play this game of finance. We want to be 3, 4, 5 steps ahead. But we just got to think, mate, next logical step, let's get this pre-approval locked and loaded, and let's move on to the next one after that. So I really just want to kind of, at the end of the episode, put a pretty bow on it and say, look, strategic broking goes into the policy part, what Nate mentioned. Strategic policy goes into that perfect triangle that I'm speaking about in terms of what problems are we trying to solve here. And if you can have this vernacular when you're talking to other investors and going, what problem are you trying to solve for? We know what we're trying to optimize a portfolio for, either net passive, asset base up to here, for example. And now if we can unlock that with this 3-step model that we're really going to put out there, I feel like strategic mortgage broking on our watch will go to the next level.
Mm-hmm. I agree.
Yeah. I'm really excited. So if you know anyone that needs help from a strategy perspective, look, we'd love to help. Reach out. People, you get a real kick when people, obviously heard my voice for quite some time. I get a kick when when you reach out to me, because this is a one-way conversation. I love when it becomes a two-way conversation. So to see people that have spent the time, spent the hours investing in your own knowledge and education. It's like, man, we'll give you the best of us. I'll give you the best of me. We'll get the best of us. I'm so dialed into what we're doing here on a day-to-day basis. I'm in the trenches with the team. So don't think that it's like I'm off limits. I'm 100% here, but I'm great for the strategy, those early conversations part. And then you'll find in our team who will kind of help you on this journey as we go far together as well. So if this episode has been helpful, hey mate, reach out, let's have a chat. I also want to be very clear about our Property Accelerator community. I'm getting so much great feedback from our investor clients when they're all surrounded by people, and it's iron sharpens iron. When they're surrounded by people that are playing a very similar game, that don't want to care about the headlines, that don't care about other people that say it can't be done, and they're going, I want to buy more property, and again, become 1% property investors, and they want to be around a esteemed company. I got to tell you now, if I was around people that ran their businesses and said business is hard, this business wouldn't be where it is today.
True.
Right? I'd just be stuck sitting in a coffee shop going, business is hard. Woe is me. When I've sat around people that are top of their game, like, how are they doing it? What are they doing? I want to implement that. We're going to take that idea. I'm going to execute on that. Mate, you just start going at a rate of knots, and team and keep up with you. It's the same with your portfolio. If you want to be around people that have a positive mindset, that have the energy to grow and scale, the property investor community is for you. And if you want to be part of that, drop us a DM. Say Accelerator. We'll send you through the details and we'll kick you off on the next call as well. Guys, I want to say thank you very much for joining me. It's a wrap. I hope that was helpful. Thanks very much.